Hi, Minnesota. This is Christie Thompson with Christie Legal, divorce and child custody paralegal and mediator. And welcome to the weekly divorce information session. Today I have with me Matt Mintz of Executive Mortgage Brokers, and we're going to give you some information about divorcing and mortgages. If you have any questions for me, please feel free to text them to me, 651-775-7899, or to send them to me in a Facebook message. Those are the ways that I would be able to get those questions so you could get an answer immediately. And if you really want to, if you're not worried about anonymity, you could put it right in the chat box. So just to give you a little bit of information on the legal aspects of divorce and mortgages. So, in divorcing, three main things happen. First of all, we value and divide all the assets of the marriage. And the general principle of how we divide them is that you each will receive 50% of all the total assets. And we're going to have, your house valued by a real estate agent or an appraisal. And we're going to have all of your financial accounts valued by your financial advisor or certified divorce financial analyst, whichever you prefer. And then all the other stuff we're going to get valued as well, like cars, Kelley Blue Book, all the stuff. And then we're going to create a marital asset spreadsheet, and we are going to divide the stuff. Now, one of the usually people's largest asset that they're dividing is the home. And so we are first, of course, just said we have to value the home, but we have to decide, do one of you want to keep the house? Are you selling the house? And if one of you is going to keep the house, do you qualify for a mortgage to keep that house? And so that is where Matt is going to talk a little bit in just a moment. And then we also divide the debts, because when you are married, every debt that each of you gets into is both of you folks' responsibility. And the debts are divided according to the legal principle of ability to pay, which just means that whoever earns more has the greater ability to pay, so they will pay a higher percentage of the debts. And then the third thing that we will do is we will figure out how you folks are going to share the children, everything from the basic parenting time schedule to holidays, vacations, all the nitty gritty, and how much the child support is going to be, if there is any. And we will handle all of that stuff. And so that's just a general overview of what happens during a divorce case. And now I would like to have Matt talk about either obtaining a new mortgage and refinancing a new mortgage, or refinancing the mortgage on the current home. And so, Matt, please take it away.
Absolutely. Well, first of all, thank you for Christie for including me in today's seminar here, a webcast. Getting a divorce is difficult, and dealing with the house can be emotionally challenging as well. I've been through that myself. There's a number of things that you want to address sooner rather than later, and ideally you want to have, before anything is drawn up in a divorce decree, you want to understand exactly what the process is going to be for whichever path you choose in dealing with your home. If you're just both selling the home, that's pretty straightforward. But what I'm going to talk about today is if one of the party wants to keep the house and they're going to buy the other person out, or just how they're going to do that. I do have a presentation here that I'm going to share if that works. Try to make that as big as possible. Is that visible now? Okay, great. So finding a house without breaking the mortgage. So the mortgage agreement, the divorce decree says who's responsible, but the mortgage still says who's liable, and they're not the same thing. So the core problem, the issues, there's four different systems we're looking at when in the house. There's the decree that decides the responsibility between the spouses, and then there's the title, which sets out the ownership, and the ownership is really the right to proceeds to the property when it's sold, as well as being able to dictate when or if it is sold. And then there's the note that has the debt liability. And then there's the credit reporting agencies who monitor all of this to make sure that everything is being paid on time. And if it's not, then obviously there's consequences from that. And so first we'll cover the quit claim. A quit claim is when you release your ownership interest in the property. You sign it over the title, but unfortunately you're not off the loan. It just means that you no longer have the ownership interest. So it transfers ownership rights, but does not remove you from the note or protect the credit. The divorce decree is very important in that aspect. So the other important thing and reason you want to talk to a mortgage professional early is that you may come up with a refinance program plan in your divorce decree, but if it doesn't address certain timelines of how things can happen, then it might not be financeable. So why it can fail is the timing of income, credit, support history, the appraised value, debt ratio, or bank overlays. So I'm a wholesale broker. I work with 20 different lenders and not a bank. So we generally don't have overlays. So the next thing to decide in the refinance is who's paying for it now. What if it's denied? What if the value is low, or sell it as a backup? Just all these different contingencies. So my role is really to sanity check whether the mortgage terms are financeable before the agreement is final. There's a provision in the guidelines that provides for when a couple is splitting and one is buying the other out, they need to do a cash out refinance. Now, what they'll do, because it's for dissolving a marriage, they will treat it as a rate term refinance. And what that means is the pricing is better. You get a lower rate for the same amount of discount points or no discount points. And you go to a higher loan amount compared to the value of the house. So a cash out refinance is generally limited at 80% or sometimes 90%, but it wouldn't go up to 97. Whereas a rate term, you can go all the way up to 97 or 96.5%, depending on the loan program. So as long as there is a divorce decree that stipulates that the house is to be sold and the proceeds go to the departing partner, then the lender can use those guidelines. And they're fairly, the document they need basically has to be signed by a judge. It can't be a written agreement between the two parties. It does need to be fairly far along the path, and not even just a letter from your lawyer. It does need to be signed by the judge. So the key issue is as underwriting requires either, as I said, the divorce decree or a collaborative separation agreement, if that's what you're pursuing, with buyout terms, and that gives you favorable pricing. So done right, the transaction may price and underwrite better than a standard cash out. So the other aspect is if you have the separation agreement or divorce decree and you haven't refinanced it, you're both still on the loan. Once that's in place, if the decree states that the debt goes to this remaining partner, it will immediately be removed from your debt to income. So it will not be considered for qualifying purposes as a liability that you need it to meet every month. It's still reported to credit, so you can still have negative consequences or good consequences if a person has great credit and payment practices, but it can negatively affect you. But it won't impact your ability to buy a house shortly after. So it helps with quality and does not release creditor liability. So basically, the cleanest divorce agreement is not always the most financeable one, and that's why you want to talk to a mortgage professional beforehand, and we can do a pre-approval, pre-qualification, really assess what are the different factors in play and how are they going to affect your income and your liabilities as we determine what you're eligible to purchase. That's a quick overview.
Awesome. Thank you for all of that information. And I do want to point out and highlight what Matt said, that, just because you want something to happen mortgage wise doesn't mean it's going to happen. And when people work with me and they have a house and one of them says that they're going to keep the house, the first thing I ask them is, have you spoken to a mortgage lender? Because I am not going to write up a divorce agreement that's just not going to fly. And so, the person needs to, meet with a mortgage lender, at the bare minimum, be pre-approved for the mortgage to take over, excuse me, not only what is owed on the mortgage, but after we divide the marital assets to, whatever amount of the equity in the home the other person is going to be receiving, roll that amount into the mortgage. So, say you folks owe 250 on the mortgage, but with the way that the asset division worked, you also have to pay the other party $100,000 of the equity in the home. Then that means that you need to get a mortgage for $350,000. And that means that you alone have to qualify for $350,000. And, and that's when you gotta reach out to Matt and give him everything that he needs to figure out if you qualify for a $350,000 mortgage. And we don't currently have any questions in the chat or in my Facebook messages or in my texts. And so, Matt, do you have any more things that people often ask you when they're divorcing and either wanting to obtain a new mortgage or refinance the mortgage?
Sure, there's lots of questions. First of all, I just want to throw out there, coming to me, there's no charge for my services. I'm a licensed loan officer, so my compensation is based only on closing a loan at that, the lender pays me at that time. So there's no charge to coming to me. There's a lot of different scenarios that can happen. I mean, sometimes a party wants to buy a new property before they're even divorced, and every person's situation is different. He was able to qualify based on his income to purchase another property. If they're not able to do that, then they can't be in a tight position. They really need to resolve what their housing is going to be going forward. And talking to me sooner rather than later at least helps identify what the issues are that you may need to deal with going forward and address them proactively rather than reactively.
Absolutely.
And just another comment. I mean, I'm dealing with this right now with a borrower. She has a ex-husband who has a car loan. They're joint borrowers. He makes all the payments and has been the whole time on time, but the lender needs to see documentation that he's been making those payments. And the only way they can do that is for her to ask him for that documentation. That's not something she wants to do. So, we'll run into a little bit of a situation there. But this doesn't have anything to do with mortgage, but there's less than 10 months owing on the liability, so it can be excluded in that case. So, I mean, excluding liabilities is if it's possible, it's the best way to go. But just keep in mind that there's going to be documentation required to achieve that. If someone else is making a payment on something that you're liable on, you will need documentation to show that they are actually making those payments.
So would that be like an example of that be like if there's a car loan and both spouses are on the car loan, but one spouse has been paying the car loan the whole time.
Yeah, that's exactly what the situation is. It has nothing to do with the house. It's a car loan, and they needs to show that it's been paid for the last 12 months. And I guess they're not on great speaking terms, or she doesn't want to. I mean, that's difficult to ask anybody. Give me 12 months of your bank statements to show that you've been making your payments on time. It's like, why would I need to do that for you? So these are things that you need to, to try to deal with. But it can be excluded if it's not your debt. If that's dealt with in a divorce decree, then it can be excluded. But just addressing every little aspect of anything that's going to affect how you appear on a credit report, how something's going to affect your liabilities, and just dealing with that, beforehand. Also, another factor are support payments. Those are taken out of those are considered liabilities. And for the other party receiving it, that can be included as income if you so choose. It's not required to include as income, but it can be included as income. And the test there is likely to continue for 3 years. So for child support, um, we've seen people not qualify because the kid is 16 years old and there's not 3 more years of child support. So there's just different factors there's a lot of different factors that go into it. And, a qualified mortgage professional is someone who can help you determine that.
Yeah, let's talk for a minute about the child support and spousal maintenance payments. And not only do you have to receive those for at least 3 years, um, but you have to wait and have at least 3 or 6 months of continuous payments before they're even counted.
Mhm.
And most of the time it's 6 months. Very few instances would it be 3 months. And so when I'm writing divorce documents, I always encourage people to just, write it for 3.5 years minimum, because you don't know, if you're going to find that dream house that you can actually afford right away. And you want to make sure there's 3 years left by the time you find the dream house. Otherwise, it's, not going to work at all. And, and these are like the kind of little, but super important things that, you need to be talking to a legal professional and a mortgage professional, or you're not going to know them. Case in point, I was at a professional event the other day, and someone had done the divorce themselves, and the two parties did it themselves. And they wrote in their joint petition for a dissolution of marriage that one of the parties was going to assume the mortgage within 2 months. And so this lady is like, yeah, I was supposed to assume my mortgage like 2 months ago under the divorce decree. And I was like, well, first of all, most mortgages are not assumable. And you would have to have talked to your mortgage, who you currently have your mortgage through,
Mhm.
to figure that out if it is assumable. And I'm like, yours is probably not assumable. And so, Matt, am I correct in remembering that assumable mortgages are FHA and VA?
That's correct. And USDA, the government
Oh, and
mortgages. Mhm.
okay.
Those are
Yeah.
generally assumable. Conventional may or may not be assumable. It depends on the lender. It will say on your note when you sign the loan agreement whether or not it's assumable.
Oh, okay. Thank you. That's the key. It would say on the note. Okay.
Mhm.
Gotcha. Yeah.
Or
That's
in the
actually,
closing document,
oh, in the closing documents. Okay.
closing disclosure.
Yeah. Because, the lady, and
Mhm.
she didn't even know the difference between assuming and, you know, refining. And, and this is why we just don't do these things on our own. And, fortunately, she has a very kind ex-husband, who I'm pretty sure is going to give her time to figure it out. But he could hire a lawyer and, just make her immediately sell the house, because it's past when they agreed that she would assume the mortgage, which honestly, she would have to refi it in all likelihood. And yeah, she said she's not gonna qualify to refi anyway, so she'll be selling it. But there's just like so many moving pieces that, Matt and I cannot impress upon you enough that you need to talk to us, figure out all the moving pieces, all the little parts, and then put all the parts of the puzzle together.
Mhm.
Because if you don't have one piece of the puzzle is not complete, and it can make the whole puzzle fall apart.
Exactly. And another part about title is in Minnesota, it's one to buy and two to sell, meaning that one party can buy a property, but if it's a marital asset, then both signatures are required to sell unless they've given a quit claim and release their interest.
Yep,
So that
yep.
can be an important part of the process, depending on what you agree upon.
Yeah, and
The
that's another
important thing
thing.
is to make sure what you agree upon is actually something that works in the legal and mortgage system. It may sound like a great idea and really fair, but if it doesn't work, it can make things worse.
Absolutely. I'm sure it sounded to them like, oh, this is awesome. You just assumed
Mhm,
the mortgage, you know, but the mortgage company has to agree with that.
mhm. And the process of assuming a mortgage is much longer than a refinance. It can take up to 3 months. And I mean, they kind of drag their feet on it, honestly, because there's no new money in it for them. It's just an overhead administrative thing. So it's not going to happen quickly. Whereas a refinance, there will be, you can get that closed, as short as 3 weeks.
Hmm. And I'm assuming, I mean, I've been told that to assume you have to qualify to assume as
Oh,
well.
absolutely. You have to qualify. Otherwise, they're not going to turn over the responsibility for a note to somebody who doesn't have an ability to pay. There'd be no reason for them to do that.
Yep. And that's what I've tried to explain to people is that, like put yourself in the position of the mortgage company. When you have two people paying, that's, two people that you can get money from. Why would the mortgage company just say, that's okay, one of you people, we don't want to hold you accountable anymore?
Mm,
Yeah.
and
So
absolutely, that's
I'm not seeing any more questions anywhere. Do you have any last thoughts for people about divorce and mortgages?
no. Just if you have any questions, give me a call. My number is 952-818-4265. Message Christie, and she can put you in touch with me. Or it's Matt@loanswithmintz.com.
Yeah, and Matt and my contact information will be with the post very shortly. Um, and easy download and all that fun stuff. And then I will add all of our contact information. We give everybody free consultations. So please reach out. We want to make sure that you get the help that you need. And so I hope that everyone has a great rest of this pretty gloomy, but still fairly warm for spring day. And again, please reach out. Thank you so much, and
Absolutely.
everybody
Thank
have
you.
a great rest of the day.